Hello to you all, welcome back to our next session for India Global Week. So far today on this stream we've certainly talked about all sorts of key issues, not least the response to COVID. We've looked at the future of financial payments, we've talked about manufacturing and positioning India at the heart of the world's manufacturing base. And now let's talk a little more about financing, because I think it's widely acknowledged that in the 1990s, 2000s, India maybe fell behind a little bit as that shift in manufacturing moved to Asia. And that was predominantly because it didn't have the capital investment to really cash in on the geopolitical advantages that India is able to offer. So has anything really changed, and where does India figure now as far as global investment is concerned? And what should it be doing to make sure that investment that is moving around the world comes to India? In our next panel, we're going to look at what reforms are needed to modernise and create more robust financial markets. I'm really pleased to welcome BVK, former partner at KKR and former chief executive at KKR India Financial Services, who's going to introduce his panel for the next 30 minutes or so and explain a little more about how we can modernise India's financial system to make sure it's well placed to attract the investment that's needed.
Thank you. Thanks, Ben. And welcome everyone. Welcome to the panel as well. Let me start with a quick round of introductions to the friends in the panel. First up is Nilesh Shah. Nilesh is the managing director of Kotak Mahindra Asset Management Company, a very well-known figure in the Indian financial markets. Welcome, Nilesh. Good to have you. Then we have Professor Anant Narayan, an ex-colleague from Shri. Anant is an additional director nominated by the IBA and the board of Yes Bank, amongst many other directorships Shri holds, previously with Standard Chartered Bank and also with Shri Group, a financial markets veteran. Welcome, Anant. We got Mr. Sunil Mehta. Sunil is the chief executive for the Indian Banks Association and previously served as the MD and CEO for Punjab National Bank, very seasoned banker with 37 years of rich experience. Then we've got Badri Nibas. Badri is the head of markets and securities services for Citi South Asia. Prior to this, Badri was the country treasurer and head of trading and local markets for Citi in India. Welcome everyone. It's a very interesting discussion, as we all know, and many times we keep discussing this topic even away from this conference, as many of you know. So to preface the discussion today, why is it important to reform India's financial sector? And many of us know that pre-COVID-19, this sector was already in some sort of bother, right? When you look at banks, which is 70% of India's credit markets, they were just coming out of a phase of accumulation of non-performing loans and getting rid of some of them, not all of them. And now we've got COVID. So as you move from here, there's going to be more non-performing loans, maybe now even in the retail sector. Previously, we saw it in the corporate sector. So when India needs banks to lend most, are they really capable of lending? That's the key question as far as banks are concerned. And when you look at non-bank finance companies, NBFCs have taken market share from banks between 2014 and 2019 to grow to almost 20% of India's credit markets. And that was thanks to a lot of capital that flew into NBFCs and that resulted in a growing balance sheet. And towards the last couple of years, we've also seen that they've got a lot of issues of their own. We've got many issues starting with the IL&FS crisis of 2018. And today we are at a state where many NBFCs can't access leverage for their own financing, forget lending more. Right? A lot of them pulled back from corporate lending. Then you shift to mutual funds who amongst the ecosystem are probably better at the margin. But having said which, they also have seen themselves in a little bit of bother with some credit issues in the past few months, including illiquidity in corporate bonds, resulting in lack of ability to redeem their investor calls at some points in time. Then you've got pensions and insurance, the long savings firms, who've never really been a part of the Indian bond market, frankly, because the government preempts all the savings for funding its own balance sheet. So that's in a nutshell the Indian system, which is clearly in a spot of bother. So really at this context, obviously the other aspect is, are we attracting enough international capital to augment the local financial system? That's the other question in front of us. Because unless a lot of this is resolved and we go out of trouble first and then cater to India's growing aspirations, how do we really get out of the current environment and in some ways find solutions for both the corporate sector, the manufacturing sector, and the financial sector? That's really the bunch of questions that we have in front of us. So why don't we start with Anand? And Anand, you've seen the markets for a few decades now. So as you see it in the current context, what should be the objectives when we talk of financial sector reforms in India? Let's start with that. Anand, you're in mute, I think.
Yeah, thanks a lot, BVK. Really appreciate. And thank you to India Incorporated. You guys are doing a fantastic job. When you talked about several decades, I'm not that old, BVK. Let's start with that. But in terms of objectives for the ecosystem, look, overall, we want jobs and growth for India. We have an aspirational young population, and we have to achieve a lot of growth to go into a middle-income country and eventually achieve our immense economic potential. That's where we are starting with, right? So let's start top down. To achieve that, we require a couple of things to happen. One is we need loads of investments to create jobs, investments to create output, and have this virtuous cycle of investment, jobs, and consumption going through, right? In order to achieve that, you also absolutely need a financial services ecosystem that's capable of financing that particular investment cycle, and so that growth and jobs and output can kind of come about, right? And it's a long haul. You know, we are fond of comparing ourselves with China. In the case of China, domestic credit is nearly 2.5 times GDP. In the case of India, it's about a third of that as a percentage of GDP. We have a long, long way to go. So when we set objectives for our financial services ecosystem, it's not just about survival. It's not just enough if we are getting by. We have to be fit, ready, proper, and ready for a sprint and a marathon. So it's about not just surviving, it's about getting really healthy and fit, right? Now, what's coming in the way of us achieving substantial growth in credit? We talk about ability and willingness of borrowers. I think we've got to look at ability and willingness of lenders as well. What's coming in the way of that for our ecosystem? Lots of things. First off, there is an overhang of NPAs, non-performing assets, which is burdening the ecosystem, right? This was there even before COVID-19 started, and now that's going to get even worse. Very, very tough for a system that's burdened with this huge burden to actually start sprinting. So you need a solution for that. IBC is great, NCLT is great, but given the sheer size of the NPAs, we need a one-time solution to kind of go on with that. Which means you have to recognize, you have to recapitalize, you have to reform, and you have to, essentially recover the loans as they come along, right? Second, once that's done, you also need a lot of reforms to come through, right? You can't have the same cycle of lend, pretend, and extend to continue, which means you need banking sector reforms, we need governance reforms, and we need market reforms, particularly secondary market reforms to come along as well. It's not just about the financial sector. Closely linked to the financial sector, we also have several real sectors which are dragging down the financial sector. The real estate sector, the power sector, telecom, airline and shipping, micro, small, and medium enterprises sector. Those need real solutions as well to solve their chronic stresses. And then I'll revert back to the original point. Once you have a financial ecosystem which is unburdened and now fit to grow again, you will still need that ease of investments so that there are opportunities for the financial services ecosystem to actually lend and create jobs and output. It sounds like a boil the ocean agenda, but genuinely, BVK, I think there are solutions available to each of these aspects. No reason why we can't go about doing them given what we are in right now, and therefore achieve our immense economic potential.
Agree. That's a great way to put it. I think why don't we go to Mr. Mehta to extend the discussions on banking. So Mehta, you've seen obviously the sector again for a few decades now, and we all know that we are today in a spot of serious bother. Tried to come out of it, but still very much there. So to Anand's point, when you think about it, what do you feel needs to be done? Let's start with the issues surrounding NPAs. It'll be great to get your thoughts on that. So first we get done with the trouble, then get to the next topic of growth.
So, I'll just subscribe to what Mr. Anand said. Yes, there's a need for recapitalization. There's a need for recognition. There's a need for reforms. And I must share with you that our country has really undertaken all the three of them during the last decade. If you see the recapitalization bonds, which are the way the public sector banks were recapitalized, it was a clear intention on the part of the government to bring the strength into the banking system. Then the recognition which happened, like earlier, the problem which was mounting up post 2008 crisis in the entire world, that problem of the credit was growing at a very faster speed, say 15 to 20% for a 5-6 consecutive years, and then there's a problem came when it reached to a point where they started declining. So in 2016 and 15-16, the NP recognition, the first asset quality review was started. So which started a big step in the form of a recognition of the NPS. And with that, the requirement of the capital came and the government came out with the capitalization norm. And the major reform which has come into this segment is IBC. I think if you must be fully aware that IBC is really a game changer into the entire banking landscape. It has become a very, very major deterrent to the corporates for default. So that is trying to bring in a financial discipline into the financial ecosystem and the especially about the corporates. It has brought provisions like Section 29A, which empowers that the present owner of the corporate may not be able to sustain it, may not be able to retain it if they do not comply with the requirement, if they do not pay back their dues, and then it can be sold out to different. And a lot of such cases has happened. For example, Bhushan Steel is a live example, SR Steel is a live example. So similar such cases. So this is first time in the history of India that such big size of corporates have changed hands just because of the default on the part of them or to the banks. So that has given a very strong messages. These number of cases may be less, but that deterrent effect will be widespread. Every corporate will now think that if they default, then they have a chance of losing their corporate, that may be shifted to somebody else. So the positive feature reform that has already come. Now going forward, I think the regulators are thinking through to how to come out with the new legislation. Now SEBI has come out with certain changes into their legislation. They have made investment into a stressed company a little easier. Earlier the issues were valuations at which they can offer the equity. Now instead of 26 weeks average, they have come down to 2 weeks average. So that 2 weeks average really makes it a sensible thing, and that too weighted average. It's not something that is an absolute average. So for a stressed company to mobilize equity from the market is become a better, easier option. So it will definitely attract the investments. Then the another aspect which is an enabler and is RBI regulator has prescribed that in case a company goes into stress, within 1 month of its stress, the bankers are supposed to have an intercreditor agreement to come out for a resolution. The basic requirement for this intercreditor agreement is so that resolution can happen faster. And they have created a timeline of 180 days. 180 days, you have to bring out a resolution. If you are not able to bring out a resolution, you should go to IBC for getting resolution. And if you don't go to IBC, the bankers are penalized by 20% incremental provision for the first year, for the first half, and then maybe 365 days if they are not able to resolve, then they may have to incremental 15% as a provision. So all these things are now creating a greater environment and discipline among borrowers, among bankers also, because they know if we do not take a resolution with that time, they may have an incremental provisioning requirement. So I think entire enablers are now being created in the form of IBC, in the form of regulatory reliefs and regulatory incentives, and in the form of changes into the mindset of the corporates. And this is clearly reflected into the declining gross NPA ratios of the banks. I think the ratios which were earlier in the higher range have come down to below 10% during the up to 2019, and now actually this COVID has come, so some challenges may again come. But the trend because of these enablers was really positive, and this recognition has really helped the bank. If you see the provision coverage ratios of the Indian banking system, I think this is one of the highest. Somewhere it is in the range of 75 to 80%. So 75 to 80% provision coverage ratio clearly indicate their capability to absorb the loss. Because even if a resolution happens at the 20% of the cost, there will not be any stress on their balance sheet. Right. So a large number of reforms have already come, and I think that is paving the way for proving as a deterrent for the fresh NPL formation.
Got it. Yes, we've come a long way on the banking side, and I guess we'll come back to banks in just a minute. Why don't we shift now to capital markets, Nilesh? And you've been part of many different bond markets companies, some along with us, some away from us over the past several years. Right? We've all been thinking, how do we expand the bond markets to be a meaningful part of credit extension in India? Still, it is a economy that is over-reliant on banks, and bonds, especially secondary trading, remains highly illiquid. So in your experience, and especially putting the current environment in context on the one side, and on the other side, to prevent recurrence of issues where we go back to reliance on banks, what do you feel are key reforms that can be undertaken at this time?
Hi, BVK. Actually, we don't have to do much thing. There was a Dr. R.H. Patil committee report which was prepared in late 90s. Many of their suggestions are still not implemented. As Anand fondly says, that his hairs have gone, but those recommendations have not yet come through. And slowly I am also reaching Anand's category. The real challenge for us is the ability to experiment. And I'll give you a very simple story about interest rate future, and that probably narrates why bond market in India has not become deeper. So the first interest rate future was introduced based on zero coupon curve, saying that theoretically this is the best way of managing or calculating bond prices. There's no debate about it that zero coupon is better, but the whole market was trading on yield to maturity. We took 3 years to rectify that YTM can also be used for interest rate futures. When YTM came, we failed to consider that there is on-the-run security and there is off-the-run security. There is benchmark security and there is non-benchmark security. We equated benchmark and non-benchmark on-the-run and off-the-run equally. Again, market didn't trade in IRF. Another 3 years passed by. We recognized that yes, market has this concept about on the run and off the run. So we said, fair enough, we will do it. But all the settlement has to be in terms of delivery by security, not by cash. Again, 3 years passed by. Now we have come to cash settlement on YTM, including benchmark and non-benchmark. But we then forget that trading requires two sides. You require buyer as well as seller. So to bankers, we have said that you only have to hedge. And to others, you have said that you can do both kind of trading. But then we realized that mutual funds will probably start trading. So we said you need to have a correlation in your portfolio. In my equity portfolio, I am allowed to short index against portfolio of stock, even though it is proven that the correlation between stocks and index could be significantly lower. Unfortunately, on my bond portfolio, where there is a significantly higher correlation to benchmark security, I need to have correlation coefficient of more than 90%. Net over the last 15 years, every step we have taken is against the market wisdom, market convention, and which is why the product has not taken off. I think what we need is implement Dr. R.H. Patil committee recommendation of the mid-90s, and also some of the committees which have come thereafter. There will be some steps which will succeed, some measures which will fail, but so be it. Success and failure is part of the market. I think if we can bring that mindset that success and failure both will work, and we will be open to markets' wisdom and suggestion and conventions, I think Indian bond markets can be developed.
Yeah, that's very, very well put and a very clear thing to follow. Committee all laid out. Why don't we shift from there to talk about international capital flows, Badri? And I think given the lens of an international bank, India has obviously been in an environment where capital flows globally, there's been a lot of liquidity. So question is, has India attracted sufficient liquidity, or can India do more in terms of moving this multifold from where we are in the past?
Yeah, thanks, BVK, and good afternoon, good evening to everyone. If you look at how we've done, I would categorize it as a mixed performance. Purely looking at the numbers, we probably have attracted about 6% of the total global portfolio flows over the last decade, which is ballpark around the same share of the GDP in the EM world, 5 to 6% for us. But if you just peel it a little bit, it is heavily skewed towards equity. On the equity side, we probably got about 17% of the flows by our estimate over the last decade. And on the debt side, it's probably 2%, which is really the larger pool. So if you look at it in some ways, you could argue that we have actually leveraged the global equity pool with our domestic savings doing the heavy lifting of financing the private and public debt in India and effectively keeping nominal rates very high, right? Which is why I would call the performance as quite mixed. So clearly, it's a great opportunity for us because there is, as you said, in the post-GFC, it looks like there is a big expansionary policy, monetary policy everywhere, ZERP going on, and therefore there is a big surge of capital pool available, which is finding, or seeking home for investments. From our own perspective, Citi estimates of the kind of savings investment gap that we have probably over the next 5 years as we push towards a 5 trillion economy is somewhere in the range of over $600 billion. So there is a need from our point of view. There is a supply available. So in a sense, it's really therefore, creating that ability to attract the flows, right? And go forward, what do you think we can do? I would put it in 3 pillars or 3 buckets that we need to focus on. One is obviously have an enabling policy framework, which has a start point of an intent to say that, hey, we need to get the targeted or a fair share of this pie. And in terms of specifics, what I would call out on the policy side would be a clear focus on ease of access, benchmark inclusions. For example, just when we talk, Australia is a perfect example right now of how their public monies and institutions are suffering from a lack of investment opportunities as their savings and pensions really go much big in size. And when we want to present India as an alternative, the first response we get is that, well, most of them are benchmark followers. So the moment you're not in a benchmark, that becomes a big no for much of the global pool available. So I know that there is a lot of work already happening on the benchmark inclusions, but I think it'll be useful if we can have a very clear roadmap in terms of time frame by which we would want to get there. And another thing from a policy perspective is enabling policy is apart from the ease of access, we also probably need to have an exchange rate policy which absorbs the capital flows to build counter-cyclical buffers and prevent excessive two-way volatilities. The second pillar I would say is to ensure that there is a modern and deeper financial markets with enhanced participants locally. I think Nilesh touched upon with us very clear and a very nice example of how we take a long time to get some of the newer products. And what I would say is probably we need to change our mindset from an excessive regulatory, regulation in these markets to a lighter regulation but tighter supervision. Excessive regulation need not necessarily avoid bad apples, but at the same time, it can have perverse outcomes. So, a shift towards a lighter regulation but tighter supervision probably would be a better mix to deepen the markets and avoiding some of the bad apples out there. And also, I think when we modernize our markets, we also probably need to have an approach towards a financial center approach. If you look at it, India is clearly in a good time zone from having a lot more market participants out there in the domestic markets. And Middle East and Hong Kong, Singapore over the last few decades have taken that. I know that we've got the GIFT City going, and I think that's a great initiative, but probably we can do a bit more to scale that up and also bring Mumbai into the picture. The third pillar is really...
You tell me in time after 6:50.
Yeah, Nilesh, can you put yourself on mute? Sorry, Badri, go ahead.
Yeah, the third pillar is really modernizing the ecosystem, right? And what I mean by that is the laws, the legal rulings, the interventions for easy judicial, into financial markets, the tax laws. I guess, that's another area where we need to focus upon to create simpler rules, protect, from easy judicial interventions, probably having specialized courts to deal with financial contracts, and also have consistent laws, without constant tweaks. So in summary, I would say that we probably need to get a fair share of a growing and a large pie out there, which is also a need for us. We need to have a very good, strong policy framework, a local, modern and deeper financial markets, and also change the ecosystems which goes with it, and have simpler and consistent rules around that.
Perfect. I think that's a great summary of things that can be done to attract more capital flows. Just turning back in the last several minutes that we have, back to you, Anant, on really talk us through international examples that you believe could be useful as learnings from where we can pick up and say that, look, if we have issues in our financial sector today, what are good examples that we can try and implement in India, or use that, massage it a little bit, and make our own financial sector more robust?
So BVK, one area which is close to my heart is this area around NPL recognition. I completely agree with Sunil Saab's earlier points, which is that IBC and NCLT are fantastic reforms, and I think they're very good for the medium to long term. When on a flow basis, I think they'll work like a charm. The problem is we are sitting with this very, very large, overhang of NPLs, and it is no bankruptcy system in the world can be geared towards handling these kind of sizes at one shot in the time frame that we want them to be resolved. So in terms of resolving and non-performing assets, there are lots of international experiences. Countries like Korea, China, Indonesia, Thailand, Malaysia, lots of countries have had experiences in this. One country which I think closely resembles our ecosystem in terms of the NPLs is Malaysia. Specifically, there was this, after the Asian crisis, they came up with this Dana Harta and Dana model, which I think worked like a charm. Very broadly, BVK, the way it worked was the following. They set up an entity which was funded essentially by recap bonds, the same kind of recap bonds that Sunil Saab mentioned for recapitalizing Indian banks. It was set up using that. It was manned entirely by professionals, including sectoral professionals, including foreign professionals who are experts in the sectors like palm oil, etc., where there were lots of loans in Malaysia. Lots of distressed debt. In fact, the level of distressed debt in Malaysia at that point, as you would imagine, was far higher than what we are facing right now. It's quite large, right? What they did was every loan beyond a certain size, they actually tried to do a valuation independently as this Dana Harta entity, as this alternate investment fund, right? So let's say for a particular loan, they were saying for 100, we will give you 50 cents to the dollar. And that's the price that we think is the right price. Now, one issue that we have today is what is the right price, and how do we ensure that transfers can happen at the right price to the bad bank? So the way it worked was the following: 50 cents is what the bad bank quotes. The bank which has got the loan has full right to say, I will not give it to you at that price. I think it's a very low price. In which case you have to provision up to 50, which means take down the provisioning to the level where the bid is. Otherwise, if you give the loan at 50, and let's say the actual recovery is 80 over the course of 3 or 4 years, you get back 80% of the upside, which is 24 cents in this particular case, back to the original institution. So there was a lot of incentive for each institution to actually sell down its bad assets to the bad bank. There was no downside for them. There was upside in case the recovery was better and the NPL was off their back. Now, what happened as a result, BVK, was all these bad loans came up to the government effectively. And what they could then do was pursue the recovery process as the government being the owner of those assets. In many cases, there was a requirement to change laws, etc. Now, it's a lot easier to change laws towards resolution if you as the government is the owner, rather than having a private sector entity, right? And this was a time-bound program. This Dana Harta had to close down in 5 years' time, and it actually closed down in 5 years' time. It recovered about 59% of the assets, which was a very, very good recovery rate in the Asian context. So at multiple levels, the fact that there was a way of figuring out an acceptable price to the buyer and the seller, there was a bunch of experts who went about the recovery in a very professional manner. A lot of the assets, by the way, were actually restructured and brought back to life. They were not necessarily broken up into pieces. And finally, the burden of the non-performing assets went away from the banking system, and a whole host of reforms was conducted on what was left. It wasn't a bailout for either for promoters or for bankers. The accountability and the reforms went alongside so that this whole cycle doesn't repeat all over again. So it was not a bailout. It was merely a quarantining of bad loans, a good recovery process, time-bound recovery process. And the final financial ecosystem which emerged was quite reasonably robust. In fact, the recovery in Malaysia was amongst the quickest. A lot of parallels, I think, to the Indian context. Obviously, every country is different. We would have to tweak this to our own context. But a lot of lessons, I think, that we can draw from the Malaysian experience.
That's a great way to put it, and then I'm hopeful that policymakers will take note. So let's hope we get there. So in the last few minutes that we have, the one topic that we should probably touch on, and Nilesh, maybe you can cover it, is really around governance. And we've had issues in governance both in the corporate sector and the financial sector in the past several years. And as we think about making our own ecosystem more robust, this is an area that eventually needs to get fixed to attract more flows and make recurrence at least a lot less frequent in the future. So can you touch a little bit about your perspectives on how do we improve governance and transparency?
If we see equity market, by and large, there is great incentive for people to improve governance. Partly it is happening because SEBI as a regulator and government under Ministry of Finance and Ministry of Corporate Affairs is setting higher and higher benchmark. Partly it is happening because market and investors are rewarding good governance companies by giving them capital and by giving them higher valuation, even if they are not in need of capital. Somewhere there is a carrot available for companies to be better governed under regulatory pressure and under market pressure. And in 2020, we have seen that such companies have access to capital, whether it's equity or whether it is debt. So somewhere over the years, we have covered a long distance in improving corporate governance from equity point of view. Unfortunately, the same has not materialized on the debt side. In debt side, the real challenge comes in enforcement of contract. Judicial process has its own burden, and hence enforcement of contract becomes quite litigious in nature. This is forcing investors, lenders to lend against the willingness of promoters to pay rather than ability of promoter to pay. Instead of trusting agreement, I'm trusting track record of promoters to lend money. And that is impediment for development of market. How do we bring rule of law into the debt market where contracts can be enforced in a timely manner? It's not that contracts aren't enforced in India, but it takes a lot of time to resolve issue. And hence lenders are pricing that risk in a completely different manner. So we can learn from equity market where regulations and market goes hand in hand to incentivize promoters, management to improve governance and disclosure. And by bringing rule of law from that point of view, we can ensure that people start respecting rule of law, contracts are enforceable, and that automatically will improve governance standards for lenders as well as borrowers.
That's a fantastic way to put it as well. So I think that's pretty much the time that we have. To sum it up, I think between what we have on the banking side, capital market side, and in terms of capital flows, there is a bunch of work that has been done in the past few years specifically, especially since 2016, since the bankruptcy code came in. But I think we clearly recognize that a lot more needs to be done, right? We all feel that to get to a 5 trillion or a larger economy, the financial sector is a very critical component. It is in a spot of bother, but there is a lot of work that has been done in the background. A lot of it is about implementation. So we need to get the right key prioritized ideas and the right implementation to move from there. So that's the summary from us from this panel. So Ben, over to you.
So much. Really interesting to hear the thoughts of your guests there, and thank you so much for moderating that panel for us here at India Global Week. Thank you too for your company and for your messages, your thoughts. Keep your comments coming in, use the hashtag. You can also send questions using the box that's available on the page. We're going to take a short break right now, but in just a few minutes we're going to have a fascinating interview with Shashi Tharoor, looking at how the global pandemic has been responded to in India and around the world, and also given so much uncertainty right now, where we might find some stability, some calm and some peace amongst all of this. So stay tuned for that. That's coming up right after this.